Hello and welcome to Any Answers Answered for July 2023. Tim and I have, as ever, picked two questions from the pages of Any Answers to have a look at. Our first one comes from Tracy2412, Tracy Christmas Eve. And it's a question about flat rate mileage. And the question is this, always excessive, by the way, Tracy, to say, please forgive the stupid question. Not a stupid question at all. I'm attempting to put together a simple resource for a group of sole traders on car expenses who want to understand what's going on. The question is this. Tracy has watched a revenue webinar on car expenses for the self-employed, and she seems to have heard on this course that as well as getting flat rate mileage, you can also claim interest on a loan to purchase the car. And the question, quite simply, Tim, is that correct?
Yes, it is. Now, when lecturing for the Professional Training Partnership, our firm, I use my own car, and rather than claiming the actual costs incurred for the business mileage, travelling up to Preston and back to Oxford, travelling to Coventry and back to Oxford, whatever the mileage is, I have long since claimed the approved mileage rate of 45p a mile on the first 10,000 miles a year and 25p a mile thereafter. But that 45p a mile approved mileage rate does not include an element for any financing costs that I might have incurred in acquiring the car. So if, it's not the case, but if I had taken out a loan to buy that car, then I would include a proportion of the loan interest based on the business versus private mileage, as well as the 45p a mile. Now, that is the situation, in my view, for the self-employed. For an employee, the law changed a few years ago, and although an employee using their own car on their employer's business claims the same 45p a mile approved mileage rate, the legislation specifically makes clear that that includes any finance costs, and they cannot be claimed separately or on top of the 45p approved mileage rate. Although, if I was a voluntary driver, suppose I was voluntarily driving patients to hospital, etc., and claiming the approved mileage rate of 45p a mile in respect to my volunteer driving, I would, on top of that, be able to claim the interest cost that I incurred for the miles that I drove on that volunteer driving. So it is a pretty muddied area, but in my view, and I'm not alone in this, the self-employed are indeed entitled to claim finance costs on top of the 45p mileage rate. Now, the reason why this is so murky is that some years ago, HMRC changed their guidance, and the only change was to remove a reference to the relief for finance costs. But that change in guidance was not supported, for the self-employed this is, was not supported by any change in the legislation. So my answer is yes, you can if you are self-employed. And I would strongly recommend that anybody who wishes to research this further has a look, as I did, at the very helpful article, which is cited in one of the posts to the original question. It's an article on AccountingWEB, and it was Frank FX who posted that in answer to Tracy 2412's original posting. So have a look at that. But simply, Tracy, yes, the answer is you can.
And of course, the logic behind this is that the 45 pence...
I'm going to stop you there, Giles. There is no logic. Don't look for logic. When we're looking at tax, we should not trouble ourselves with looking for logic in tax. The only logic is in the application of the rules. So we have to find the rules and then apply them logically. But that's not to say that the rules themselves are logical. And there are any number of illogical tax rules, but those rules then have to be applied logically, which is what the article in AccountingWEB very clearly sets out. It's illogical But the logical consequence of the legislation is that employees do not get the additional deduction for finance costs, but the self-employed do.
All I was going to say there was that the 45 pence is meant to cover the running costs of the car. And so the logic, if you like, is that there is this distinction between the running costs of the car, covered by 45p, and if necessary, the purchase cost of the car, and therefore the interest on a loan used to purchase it. That was the point I was going to make. Our second question comes from Nick, and in my part of this exercise each month, Tim, a blessedly short question, always a happy moment for me. Losing UK tax residence has triggered a capital gains tax, is the point here. A prospective client has mentioned becoming liable to UK capital gains tax on losing her UK residency. Nick says, I'm curious as to what sort of asset could trigger this change. So Tim, as we get on the plane, leave the country, what could give rise to that charge?
Well, the obvious answer, and I have to say the only one I can immediately think of, is because the departing individual, becoming non-UK resident, was the beneficiary of a gift within the previous 6 years. And let's imagine that the taxpayer who is becoming non-resident is my daughter, to whom I had given, let's say 3 or 4 or 5 years ago, some shares in Absolute Accounting Software Limited. And at the time of the gift, we jointly claimed holdover relief on the gain under Section 165 of the TCGA 1992. Now, where a gain on a gift of business assets is held over in that way, then the donee will become chargeable on the deferred gain, effectively. It will reduce the base cost, and therefore that will increase the liability for the donee on an eventual disposal. However, although ordinarily the deferral through the holdover will run indefinitely until a disposal by the donee, if the donee becomes non-UK resident within 6 years, then the gain becomes immediately chargeable on the donee. So let's suppose I gave my daughter shares in my company, we claimed holdover relief under Section 165, and then 4 or 5 years later, within that 6-year limit, she becomes non-UK resident. There is an exit charge on her, and she will have to pay capital gains tax on the gain that was deferred when we made the gift 4 or 5 years earlier.
And to ask you the question I always used to ask students all those years ago preparing for exams, if your daughter has got on the plane, has disappeared off, and the revenue can't find her, who gets the capital gains tax liability back?
The donor would then be liable, the revenue have recourse to the donor for any capital gains tax payable by the donee if they're unable to recover it from the donee.
Absolutely. I suspect you would help them find your daughter in that situation so that she got the tax bill.
I suspect I would pay it.
Thank you, Tim, as ever, for those answers. Hopefully useful to the 2 people who asked the questions and everybody else besides. We take a short break over the summer. We'll be back in September, and we'll see you then.